dollar index is on the negative this week as the S&P 500 took its biggest hit since last June in this Tuesday's trading. On the phone with me now to discuss his forecasts for several major US dollar crosses is Johan Ditz Lemche of NSFX. Johan, thank you very much for joining me. Firstly, what do you see as the drivers for the US dollars pairs this week? And what performance trends have we seen thus far?
Well, last week was very data-heavy for the U.S. economy, as we had both the FOMC statement as well as the U.S. job report. However, the outcome of those were a bit shaded, but still the S&P managed to print new highs, close to 1710, on back of a pickup in the ISM figures. With regards to the dollar index, it's an interesting relationship at the moment, in the sense that the correlation is moving towards a rate-oriented focus compared to a risk-oriented, as we historically have seen an inverse correlation between the US dollar and U.S. equities. This week for the dollar is pretty soft on macro data, but going forward it's all about the Fed tapering, which we expect will commence at the September meeting, and overall we expect a strengthening of the greenback against its peers in the second half of 2013, as risk premia are expected to harmonize.
Bullish UK data continues to reaffirm a recovery within the country, spurring on a pound-dollar rally. Do you see this as a long-term trend, or can we expect a downward correction in the near term?
Now, in the second quarter, sterling pairs overall managed to pick up some of the lost ground from the first quarter, but the economy is still struggling and there are still significant risks to the downside. Earlier today, the new BOE Governor Carney introduced a more activist approach in introducing a forward rate guidance similar to the one we saw from the Federal Reserve last year. Carney introduced the rate measures and said it was under extremely difficult market conditions to set the monetary policy currently. But BOE stands ready to act if additional measures are needed, and rates will be held low until unemployment has fallen to 7%. Also, the MPC upgraded their growth forecast, which has caused a significant rally in sterling pairs today. Despite the new measures, we still regard the economic conditions as weak, and given little chance for a pickup in demand following a need for a deleveraging, the most likely path for sterling pairs is to head lower. The test for the BOE will be to manage the rate curve in order to keep the incentives for growth and capital inflows present. This leads to our growth forecast, our forecast, which on a 1 month basis against the dollar is at 151. On 3 months, we expect the pair to test 147, and on a 12-month basis, we expect to move to 144.
Trader demand for the greenback appears to be wavering as ongoing uncertainty over the future of the Fed's stimulus program has damaged the Australian dollar against its US counterpart in early trade on this Wednesday. The surprise RBA rate decision has also been a major factor in this pair's trading pattern. But looking ahead, what can we expect from the Aussie dollar US dollar?
The Aussie has been on the offer throughout 2013 as the currency has lost a lot of its former attractiveness of being a high-yield currency following a series of rate cuts. It should be noted that Australia still has their interest rate in the arsenal of weapons compared to most of the other central banks amongst the majors. This time the surprise message from the RBA was that no easing bias was repeated. Technically, the pair is flirting with the 100-month moving average, which we have not seen tested since April 2009. In short term, we expect a throwback on the 1 month term towards the 92 figure before the pair eventually resume an overall downtrend on concerns in the region, along with intensified dollar bids as the results of the Fed tapering. 1 month forecast at 92. 3 months, we expect the pair to drop to 89, and on a 12-month basis, we are looking at the 85 figure.
And lastly, looking at the dollar-yen, it's another pair impacted by Fed uncertainty this week. As yen traders prepare for the Bank of Japan's rate decision tomorrow, what are your expectations from this meeting, and what market response can we anticipate?
Since dollar-yen printed 2013 highs in May at very close to the 104 figure, the market has been in a consolidating to bearish mode, posting 2 months of a decline as risk sentiment has faded in the Asian region following a general deceleration in growth, which also has triggered additional easing elsewhere in the region. On back of these external factors, we are concerned that the current measures from the BOJ won't be enough to satisfy their own 2% inflation target and boost the export-related economy. And this means that unless the Bank of Japan will be ready with the proper measures for stimulating the economy, we could see Abenomics fail for the second time. However, with regards to this meeting, we believe that the current outperformance of the yen, which has depreciated 11% against the dollar this year in 2013, will lead to the BOJ sticking to their 7 trillion program per month this time. So overall in the markets, it will be an interesting autumn cocktail with the Fed tapering along with the Bank of Japan potentially adding additional stimuli to their economy.
Many thanks, Johan. Don't go away, as Dukascopy TV journalist Monica Gibson will be bringing you an exclusive look at Norway's economy. All of this and more here at Dukascopy TV.